Guys, hello guys, welcome to the market channel. It's good to have you guys again today. How you guys doing? How is the market? How is trading go? In today's video we'll be talking about money management, the only money management video you need in your trading career, because we have many beginners, we have many new traders in the market, and they don't know about money management, or even you are an existing traders but you don't know how to manage your account, how to manage your funds. In this video everything will be broken down. So before we continue, please if you have not subscribed to this channel before and watching this video right now, please kindly subscribe now, and don't forget to like this video and also share with your friends. Thank you very much. Let's get started. So first and first, what is money management? Because you'll be like, we have been hearing this particular word, money management. Well, money management is just basically a way or a set of rules that traders do follow in order to safeguard their account balance, or in order to safeguard their funds, do you understand, or their account size. That's just money management is. It's just like we can also call it a strategy that you follow back to back. You follow with discipline, without deviating from that particular rules or that particular plan you have. So that's just basically what money management is. You know, I've done a video about risk management. I guess I will put in the link up. So, and I talk about risk and the rest. You know, I said something that in this market you must learn to accept risk as a trader, be it a forex trader, a crypto trader, or a binary option, a stock. Each trader or any trader you are, you must be ready to accept risk, because there is probability that you lose just little part of your money. That is why we have stop loss, just to reduce the loss on your account size. So, and in this trading of your career, we also have what we call emotions. Emotion comes in whenever maybe you place a trade and maybe you lost a trade, and you know, we are human beings. We don't like to lose something. Even ordinary $1, we don't like to lose it. So we get emotion attached to the market and be very, very mad at the market, angry, and trying to recoup our money back. So all those things, as a trader, you must learn to control them. But in this video, we are talking about money management, how to manage your account size. So first of all, what is the importance of money management? Well, if you are talking about importance of money management, let's check this. Let's check this. Okay, what's the importance of money management? The importance of money management is basically this, which is basically money management in trading is a defensive strategy. And I told you, it can be a plan, it can be rules that you've laid down that you want to follow strictly, that is meant to preserve capital. So that is meant to preserve your trading account, trading balance. It is a way to decide how much shares of lots or trade at a given time based on your available capital. Successful money management can save you from draining your account when you hit a basket of loss. So that's all a losing trade. So let's pick out this, and then let's dive into some real life practical. So yeah, we have different money management strategies. We have different ones, very different one. But let me just give you just a basic idea, or just that you can also make use of in your own trading. So first thing for, let's assume that you have an account balance of let me just say, let's just put every trade, like, let's just say $100. Just $100 is still fair. Okay. And on this $100, so let's assume our account balance is $100 here. So our video will not long. So balance, so our account balance is this. So now, as a trader, now you want to place a trade, and you went ahead to, let's assume we have two traders, A and B. Do you understand? Trader A, let's assume we have trader A, trader A, and we have trader B. Do you understand? So trader A places maybe when trader A wants to place trade, trader A plays $20 per trade. That is his own plan, that he should be placing $20 per trade, $20 per trade. And trader B, because he knows how money management works and everything, or he knows how to manage his account, even though trader A also knows how to manage his account, but that way he uses $20, while trader B also uses let's say $5 per trade. That's $5 per trade. And let's say we have a trader C. Let's call this one B, and let's take this one C. Let's say trader C uses $50 per trade. So you understand what I'm saying now. Let's call this one C. So now what happened on the first trade? These are first trade. On their first trade, trader A uses $50, $20 to place its trade. Trader B uses what they call it, use $5 to place on trade, and trader C uses and trader C uses $50 to place trade. So let's assume that the first trade was a successful trade for them. And let's assume that it was a successful trade. So since it's a successful trade, so since it's a successful trade for them, so trader A has additional, let's say in money management there's something you should know. We call it a risk to reward. So risk to reward, and we're talking about risk to reward. Let's just use these tools here, short and then long. Let's just use maybe a long position. Let's assume your entry was around here. Let's assume your entry is here. Assume that this is your entry. So this is your entry. You put in your long tools. Boom. So now this green part represents the profit side, while this red part represents the loss size. So sorry. So why this one represents the loss side, this red part. So now if you look at this middle part, you will see 2.5. so if you change this one, you will see 1 point something. The more you increase the loss size, you understand, the more the risk to reward ratio will reduce. And if you reduce the loss, that's the stop loss, the more the risk to reward ratio will increase. So let's assume your target is this. Do you understand? Assume your target is this. So if you are using this small stop loss, your risk to reward will be what? 1 to 4. So 1 to 4.8. So because you are losing this small amount to get times 4 of this. Do you understand? So let's assume your own stop loss is around here, like this. So that means you are using this amount to get times 3 of this. Do you understand what I mean? So let's say this difference is just 200. I mean you are risking 200 to get times 3, so to get like 600. So that's just it. So if you have a bigger stop loss and your profit is small, so that means your risk to reward ratio is very poor. But if your risk to reward ratio is 1 to 1, that is you are risking 200 to gain 200. Do you understand? So that means your risk to reward ratio is 1:1. If your risk to reward ratio is 1:2, that means you're risking, let's assume now it's 200, you're risking 200 to get 400. So you just like times 2 of your investment. So that's just it. So that is why in trading your risk to reward ratio must be very, very good. It might be 1:1, it might be 1:1.5. It depends on you, but the main thing is the strategy you are using. If you know that your strategy is 60% accurate, like the accuracy of your strategy is 60%. You know what I mean by that? That if the accuracy of your strategy is 60%, so that means your strategy must be giving you a good risk to reward ratio. But if the accuracy of your strategy is 80%, you understand, you might be going for maybe 1:1, you might be going for 1:1.5, because your accuracy is 80%. That means if you place 10 trades, you will lose 2. Do you understand? So it's that 80% is a big win. And if your accuracy is 100%, you can even be going for 1:1, 1:1, 1:1. Do you understand what I mean? But if your accuracy is around 60%, 50%, 40%, that means your risk to reward ratio should be going to maybe 1:5, 1:6, 1:7, 1:8, 1:10. Do you understand? Because by the time you lose one trade, you won't be shake. You lose another trade, you won't be shake. But you know that if you win one trade like this, it's going to recoup all your losses. Do you understand? So that's why risk to reward is very important. Just understand the accuracy of your own strategy. Check, is my strategy maybe based on past trend, backtest it. Check that, okay, is this 60% accurate, or 100% accurate, or 40% accurate? If 40%, now check the risk to reward based on your backtest. Check it. If your risk to reward is okay, maybe it's 1:4, 1:5, 1:6, do you understand? Or even 1:3, and you see that, okay, wow, this is okay, and you calculate it with your balance and say it's going to grow, fine. But if your risk to reward is poor and your strategy is poor, your account will not go. Like now, you have a risk to reward, you have a strategy of 50%, and you are using a risk to reward of 1:1. You are losing 100, you are gaining 100, and your strategy is 50%. That is very poor. The worst case, you break even. Your account may not even grow because you break even. But let's assume your strategy is even 50%, and you're having a risk to reward of 1:2. There are 1:3. So your account will still grow. So now let's quickly make our example finish, because we don't want this video to be long. So let me quickly delete this. I guess you understand what I meant by the risk to reward. So now we look at this thing. Okay, the first trade, all of them won. This one actually won. So their risk to reward is 1:1. So that's what they are using here. So this one also is 1:2, is also 1:1. We are assuming that it's 1:1. I guess that 1:1 should be the lowest. So this one also is a 1:1 controls. Okay. So now let's assume the next trade they went to, you understand, it's still 1:1. They lost it. They lost the trade. You understand? They lost the trade. So that means minus. So they lost the trade. This one also, they lost the trade also. Do you understand? And this one also, they lost the trade. Do you understand me? So let's have me place the next one also. Assumption, they lost the trade. You know, in this trading of a thing, you shouldn't be concerned mainly about the profit alone. You should be more concerned about the loss. Do you understand? How to manage your loss. Because once you are able to manage your loss as a trader, I can tell you, you're a professional trader. Because if you don't know how to manage your loss, even if they give you $1 billion, you blow that account. But if you know how to manage your loss, even if they give you $10, you can grow it to $2,000. So that does it. So now let's not check. This one have a balance of 100 also. Don't forget all of them. Their balance is 100. Now they place the first trade, it came. Second trade, it came. They understand. So let's say the third one also is a loss. Sorry. Let's say the third one is a loss. Let's include one more to finalize this video. This video will be having part 2. So this should be the first part. So we'll be going in depth in the next video. So now, if you look at this trade, the first trade, Mr. A won. Second trade, Mr. A won. Everything was going well. Third trade, don't forget their risk to reward is 1-to-1. Third trade, that means if you put any amount, they will get the return of that same amount back. So third trade, lost. Now let's check it out. This cancel this. Do you understand? So that means the account balance of Mr. A is now currently $80. So account balance of Mr. A is currently $80. The account balance of this man, Mr. B, is now currently $95. While the account balance of this man here is currently $50. Do you understand? So the question now is, let's at the end of the week. At the end of the week, let's assume they started this trade and they place each trade one trade per day, and after 5 days have this. So the 5th day, this guy at $80. You know, Mr. A will still be like, okay, let's hope that next week will be good. Do you understand? The $80 is still a good capital to recoup my money. Do you understand? Mr. B will be like, wow, okay, it's still okay, 95% and $5. Okay. While Mr. C will be like, wow, my account is down by 50%. This is bad. How do I get my money back? The market is beeping me. How do I get my money back? My balance is down by 50%. So Mr. C will be more mad than Mr. A and Mr. B. Do you understand? So if the following week should come now, let's say all of them calm down and the following week now came and they don't want to play straight, Mr. C will not be calm, because he will not be happy because his balance is down by 50%. While Mr. B will still be calm because his balance is only down by 5%. While Mr. A will still be calm a bit because his balance is only down by 20%, which is still huge, but compared to Mr. C. So now, but if you look at Mr. C, with this amount he's using to place trade, if he should have a good risk to reward ratio, you will have a more profitable than any of them. Do you understand? Mr. B also, if Mr. B has good, whether Mr. B has a good risk to reward ratio or it does not have, it will still be calm. Do you understand? Because he's using a smaller portion of a balance to place trade. Mr. A also, if he should have a good risk to reward ratio, he will be more profitable than Mr. B. Do you understand? Now, what I'm trying to drive at here is that if you have irrespective of the balance you have, do you understand, you should be ready to place, first thing first, place what you can afford to lose. Second thing is that don't use a larger portion of your balance to enter a single trade. Do you understand? Except if you are a pro or if you are experienced, you have been doing it before and you know how to manage that account, that if that money should go, you don't mind. Do you understand? You are not concerned. So like now that Mr. Mr. C has a balance of 100 and he's using 50% of his balance to place trade, is too much. If a particular loss like this will withdraw down his account, why Mr. B, look at Mr. B is using 5% of the balance to place trade, just a single loss, Mr. B will not be moved that much because it's just 5% of his account. The C has 95% to go. Mr. A also, look at it, he's using 20%. 20% is also much. So if it is Forex, they will say that the standard one, the standard loss side, I guess 0.1 or 0.01 or so. I'm not really into Forex like that. I get my micro lot, I guess 0.01 or so, and that should be around 1% of the balance. Why 0.1 is 10% of the balance. Sure, I understand. So I feel that between 1% to 10% of the balance, between 1% to 5% of the balance is okay for you to place trade. Between 1 to 5, especially if you are just a new beginner. If you have $1,000, you can be using, if you are a futures trader, you can be using $10, you can be using $20, $50, $100. it's still much, but you can still use $100. You understand? But if you have a bigger balance, you can be using. But the standard loss type for you to, especially if you are just into trading, you need to grow your account first. And how do you grow your account? Is to have a good money management. Don't let greed to overcome you or overshadow you, because you might see someone posting 5,000%, 100,000%, 47,000%, and you are so carried away with those percentage. The main thing is that don't be carried away. Trading is more like a journey. It does have to continue working, continue moving in that particular race. You don't, everything is not a it's not that you invest 2 naira today and win 100 billion tomorrow. No, it's more like a journey that you have to continue in day and day. So what I'm trying to say is that in our next part we'll be talking more about that. But what I'm trying to say in this video to conclude is that, irrespective of your balance, sit down and calculate, which amount in this my balance can I place on a single trade, that once I place it and the trade did not go in my favor and the money will not move me. If you have $1,000, if your own balance, if what you can afford to lose is just $20, you put $20 per trade, and if your risk to the reward is around 1 to 3, you're getting $60 in return. Do you understand? So and if your own is $100, put $100 per trade, and if your risk to reward maybe is just 1 to 1 or 1 to 2, you get $100, $200 in return. Do you understand? So that when your account, all these things is just to safeguard your account. Just like now, you need to that you fund your account $100 or $1,000, and be following the 2 days later your account is done. You blow your account. That's very, very bad. So you need a good risk management. You can see the example of Mr. A, Mr. B, and C. Mr. A is using 20% of his balance to place trade. Mr. B using 5%. Mr. C is using 50%. And look at when they entered loss. Look at the person's account that was drawn down most, and just look at the way or who is going to be mad at each other. So that is just it. And there's something that we call market revenge, because when you see your account balance is getting reduced, your money is going small, you'll be getting mad at yourself and you don't want to calm down and place with the game, which is called market revenge. So for you to be able to avoid market revenge, you need a proper good money management. So you understand? And this thing is discipline. It's what you can do yourself. It's discipline. If your plan is to use 0.2, if your plan is to use 5%, 20%, 10%, consistent with it. It's not that you use 5% in this one, you use 10% in that one, you use 20% in that one. Because if that 20% you place, you lose, your balance is down again. So be consistent in the amount you are using to place your trade. Do you understand? Let's assume now, look at Mr. C now. Let's assume now Mr. C, he placed the first one $50, it came. Second one $50. Mr. C now decided, okay, let me place $100 that my trade is coming. He now place $100, now lost. Look at everything will be gone again. Maybe place next one, is lost. You see the deal balance is down. So that's just it. Just be consistent in whatever you are doing. So in the next video, we'll be talking more about some tips and some different type of money management strategies in which you can use for yourself. Thank you very much. Really appreciate for you to stay to the end of this particular video, and in the next video we'll talk more about money management. Don't forget to like this video and subscribe, and also share with your friends. Thank you very much. God bless you all and have a wonderful day. Thank you.